Hi everyone, my name is Jimit, and in this video, I'm going to be talking about a few recent macroeconomical developments that have been taking place and how that will be important for us as investors and traders likewise going forward in the markets. This video is going to be divided into two parts. The first part is going to be me discussing why, according to me, the FIIs are exiting the Indian markets, and not just Indian markets, all emerging markets, but I'm going to be discussing about the Indian markets in particular. And in the second part, I'm going to be discussing about how the interest rate changes done by the central bank is going to have an impact on the economy. So now, for the first part, I'm going to show you two charts. The first chart is going to be of the US 10-year bond yield, and the second chart is going to be of the USD INR. So this is the rate at which $1 gets converted into Indian rupee. Now, what happens is, let's assume that the Indian markets provide a return of 12% for the entire year. Now, a year back, at start of 2024, the FIIs had invested in the Indian markets. And at the end of the year, they wanted to exit their positions, book all of their profits, and show it on their books. Now, what is going to happen here is that the FIIs are going to make, say, a 12% return. On an investment of 100 rupees, they are going to make a return of 112 rupees. So that's a 12 rupee profit. Now, what's going to happen is that a year later, when the FIIs convert the Indian rupee back into dollars, because the dollar has appreciated in value, which means the rupee has depreciated in value. And because of that reason, when they convert the 112 rupees back to US dollars, they will get less US dollars as compared to what they would have gotten at the start of 2024. Now, I'm not going to do the calculations over here. I'm just going to give you simple numbers over here so you can get an idea, a rough estimate of what is going to happen. Now, the 12% returns made by the FIIs in the Indian markets have become less because of the rupee depreciating in value, which means the FIIs are going to get less dollars in return when they exchange the rupee. Now, say because of the depreciation of the rupee, when they convert it back to dollars and then they look at the returns, it goes from a 12% return to an 8% return. So there is a direct 4% hit on the return side of the FIIs. Now, this is where the US 10-year bond yield comes into play. Now, the US 10-year bond yields is currently at 4.2%, which was at its peak somewhere a little close to 4.8%. Now, what exactly are the government bond yields, you might be thinking? So, a government bond yield is nothing but a debt instrument offered by the government. It's very similar to an FD where you put your money in and you get a risk-free return of say 4.8%, which was the yield at its peak. Now, what's going to happen here is thinking from the perspective of an FII, you have two investments now. One is an emerging market where you're going to make 12%, but after the depreciation of the currency of the emerging market, the returns will drop down a little below 12%, let's say in our example, 8%. And at the same time, you are getting 4.8% returns on the 10-year bond yield. Now, if you're looking at it from a risk perspective, what's going to be happening is that the FII will be thinking, look, I am making 8% by investing in the emerging markets, while at the same time, I'm making 4.8% risk-free over here. In the emerging markets, the FIIs always have a factor of risk involved, where they have to look at the risk. I mean, there's not a guarantee that you're going to be making 12% before the conversion rate return on an emerging market. It can also be that you're making 12%, 15%, 20%, or maybe even making negative returns. So now when you look at it, the FII will think that I am putting more risk by investing in an emerging market where the return certainty is not there. But at the same time, if I invest in the 10-year bond of the government, which is the safest source of investment because it's practically risk-free. Now they are going to be making 4.8% risk-free. So because of the rupee depreciating in value, what's happening now is that the FIIs get into a dilemma where they have to look at it from a risk perspective on where to invest for the temporary time period. Now, because everyone thinks about investments with risks in mind, a rational investor actually, they will always think that, definitely making 4.8%, a little close to 5% is better than making 8% with a degree of risk involvement, where there's going to be two types of risks. One is going to be the price risk, that the markets underperform due to XYZ reason. And the other risk is going to be the currency depreciation risk, because of which the return after converting the foreign currency back to US dollars is going to be maybe even lower than 8% if the rupee depreciates more. Now, they will think that it doesn't make sense to invest in emerging markets. So they will pull all of their money out. Not all actually, but a big chunk of their money out. They will definitely go booking profits in a lot of companies which they have invested since like the last 2, 3, 4 years and on which they are setting at real good returns. Now, when this happens, this will lead to a selling done by the FIIs, which we can see in the last few months, where FIIs have been constantly selling and they've sold a little over 1 lakh crores since the start of this year. Now, because of this reason, I feel that the FIIs, because of the rupee depreciation and the increase in the bond yields, because it might be possible that 6 months down the line, the 4.8% bond yield can also go to 5.5. Now, the difference between the returns made in the emerging markets of 8% and on the bonds, which is a 5.5%, there's a very small, the cap, the difference between the returns made in both asset classes becomes even thinner, because of which any rational investor would be thinking that no, it makes sense more to invest in a risk-free asset for the time being because I'm getting good returns on the bonds, which are risk-free, instead of investing in the returns, investing in emerging markets, which are risky. Okay, so now let's move to the second part of the video where I'm going to be discussing how rate cuts done by the central banks have an impact on the economy as a whole. Now, for India, the central bank is the Reserve Bank of India. Now, the RBI decides what the repo rate is, which is the rate at which they lend money to commercial banks, which in turn lend money to public and to industries as well. Now, I'm taking an example over here that according to the current stance, up until a month back, the repo rate was at 6.5%, which was constant since 2023. So since 2023 till January of 2025, the repo rate was at a constant of 6.5%, which means that the RBI is going to lend money to the banks, to the commercial banks at 6.5% interest rate. Now, we're taking an assumption over here that after a few more RBI monetary policy committee meetings, there is eventually a 200 basis point rate cut which happens by the RBI. Now, after the 200 basis point rate cut, the repo rate drops to 4.5%. Now, what's going to happen is that at 4.5%, the commercial banks are going to get money at a cheaper rate. And because of this reason, they are also going to lend out money at a cheaper rate. Because of which, or the interest rate on debt taken by people is going to get reduced. Now, we look at an example from an industry perspective at what is happening. So now I have taken three examples, three scenarios over here. In each scenario, the company has taken up on a debt of 100 rupees. And in the first scenario, we can see that the interest rate is 6.5%, which was the repo rate. Now we are assuming over here that the RBI's repo rate is the same rate at which the commercial bank is lending money to an industry, to a company, say for example, Reliance. Now, at a 6.5% interest rate before the rate cut, the effective debt that the company would have had to pay back to the banks was 6.5 rupees. at a sale of 100 rupees done by the company and 60 rupees expenses and the 6.5 rupee interest that the company will have to pay to the bank, the PAT comes down to 33.5 rupees, which gives us a PAT margin of 33.5%. This was what the PAT margin was before the rate cut had happened. Now, in the second scenario, what's going to happen is that the sales is going to be the same 100 rupees. The expense is also going to be the same 60 rupees. And the interest rate is also going to drop down now to 4.5 rupees because of the 200 basis point rate cut done by the central bank. Remember that we are still making the assumption that the interest rate charged by a commercial bank to the company is the same as the repo rate charged by the central bank to a commercial bank. So now at 4.5% interest rate, the effective debt will come down to 4.5 rupees from 6.5 rupees. And the PAT will increase to 35.5 rupees. Now, because of this increase in the PAT, there is going to be a slight improvement in the margins of the company. So now the PAT margin is going to be somewhere close to 35.5%. Now, remember, this is a hypothetical situation over here. In the third situation is what actually happens in the market, in the industry. And I'm going to come back to this after I explain the retail side of things. Now, let's get to the commercial side of things, where we are going to be looking at what is happening on a public level from a consumption's perspective. Now, before the rate cut, the repo rate was 6.5% to the central bank. Now, the central bank is going to be lending money to the common people at, say, 7% after adding a margin to it, which every bank does. A few basis points here and there at a premium, they give a interest loan to the common people. Now, the rate of an EMI is at 7%, which means for every 100 rupees that you borrow, you are going to be paying 7 rupees. Now, over here, we are taking an example of the consumption done by a group of people paying 100 rupees. After the rate cut, what is going to happen is that the repo rate was 4.5% to commercial banks by the central bank. And the commercial banks will charge people an interest rate of 5.5% on EMIs and loans that they take. Now, because the interest payable by the people to the commercial banks has dropped from 7 rupees per 100 rupees of loan that they take. Now they have to pay 5.5 rupees for the same 100 rupees of loan that they take. Now, because the interest rates have dropped, the buying power of the retail will increase. And because the buying power of retail people will increase, it's obvious that the consumption is also going to increase. Now, the consumption, which before the rate cut was at 100 rupees, is going to be more than 100 rupees. It will have a multiplier effect on the consumption. And now, since the loan has become cheaper and people can consume more, they are going to spend more money and inject more money in the economy. Now, where will they inject money? They are going to buy more products. They're going to buy more, say, food items. They're going to spend more at restaurants. They're going to take EMIs to buy appliances like TVs, refrigerators, etc. Now, what's going to happen is that because their consumption will increase, it will have a direct impact on the revenue, the top line made by a company. Now, because there will be a direct impact on the top line, if every rupee spent by a person goes to the top line of the company and a person spends, say, 100 rupees in the first example before the rate cut, the top line will be 100 rupees for the company. Now they're going to be spending more than 100 rupees, and because of that, the top line is also going to increase. Now, let's get back to the third scenario on the industry side of things. So now the debt is going to be the same. The interest rate of the debt is also going to be 4.5%, which is the rate after the rate cut. Now, since I mentioned in the last slide that the consumption is going to be increasing from 100 to more than 100. There's no definite number, but it is obviously going to increase more than 100. And because of this, now the company is making a top line of 125 rupees. Now, of course, the expenses are also going to increase because the quantity sold is going to be increasing because the consumption is going to increase. So now the 60 rupees expense is going to go a little higher to 70 rupees. And the interest is at 4.5%. Now, the important thing to note over here is that the PAT margins are almost 40.4%, which before was 33.5% before the rate cut was done. So this is almost a 7% increase in the PAT margins done by the company. And this is going to boost the economy as well because growth in the company's profit is going to be a sign that the economy is doing well. And because of this reason, a small rate cut of 2% has had a magnifier effect on the PAT margins of the company, which is also going to be increasing the GDP of the country. Now let's take the same example where we will be talking about what will happen if there is a rate hike in the economy. Now, say the interest rate, the repo rate before the rate hike was at 6.5%, and after the rate hike, it goes to 7.5%. An increase in the rates by the central bank is going to suck out liquidity from the markets. How is it going to suck out liquidity from the markets? Is that because now the repo rate is at 7.5%, borrowing will become more expensive for industries. Now, what's going to happen is that the same person will be like, the loan has become more expensive, and I'll focus only on my needs right now, not a lot towards my wants. And because now the consumption of the same people will decrease, it will have a direct impact on the top line of the company. And at the same time, it will also have an impact on the profitability of the company from a PAT perspective because of an interest increase in the interest rates and increase in the interest expenditure. So now if you look at this same example over here, now interest rates are increasing and consumption will reduce, which will lead to the slowdown of an economy. Say before the rate cut, there were 100 units that were being consumed in the economy. Now, because the borrowing has become more expensive, the consumption will drop down to say 90 units. Now, at 7.5% interest and a decrease in the top line of the company to 90 rupees, what's going to happen is that the PAT margins are going to drop to 30.6%, which was 33.5% before the rates were hiked. So now this is a direct roughly 3% hit on the PAT margins as well of the company. And because of this reason, what's going to happen is that the company is going to show less profits. Now, the GDP growth rate is also going to slow down because, of course, the consumption has also slowed down. And because of this reason, this will lead to a slowdown in the entire economy as a whole, which is a bad thing for the markets. Now, when we look at the current scenario, the repo rate was at 6.5% up till last month, which has been dropped down to 6.25% in the rate cut done by RBI. Now, RBI is also planning for a few more rate cuts going forward, which will definitely increase liquidity in the markets. And when the liquidity is injected in the markets, it will lead to an increase in consumption. At the same time, in the budget of 2025, we have also seen that the tax slab has increased, where up to 12 lakhs, there is no tax that is going to be paid by a person. This increase in the tax slab is also going to be helping boost consumption for the economy as well. And because of these reasons, the budget and the rate cuts will lead to more liquidity in the markets. And going forward, we can see that the markets can perform well. Now you might be thinking, oh, okay, all of these things are happening, then why are the markets still correcting? Why are the markets still falling? It's a very good question. And a simple answer to this question is that the market, the economy actually, will see an impact of the rate cuts, usually a little close to a year and a half later after the first rate cut. So, say the rate cut has happened in February, the direct impact we can see by the end of this year, or a little close to as latest as the middle of next year. But that is when the direct impact is going to be seen in the markets, where the liquidity is going to increase. And at the same time, RBI is also doing a few open market operations where they are going to be buying back bonds. And with this, they are also injecting liquidity in the economy because now they've realized that after almost 2 years of no rate cuts, the markets have definitely slowed down at this point, which we can definitely see from the earnings of almost every company. Where, yes, definitely, there have been a few companies that have been performing well, but I can see at least more than 50% of the companies listed in the market have seen a slowdown in their growth in sales and profit margins as well. This, along with the absurdly high valuations that the market has given all of these stocks in the last 1.5 year bull market, has led to a fall because now I'd say a 80 or a 100 PE, the company cannot justify the 80 or 100 PE by showing a spectacular increase in profits. Now the growth rate of profits has decreased and has had a slowdown, because of which now they can't justify having such a high PE. And because of this, what is going to happen is that there is going to be a price correction. Now, if we look at the markets, we can see that Nifty as an index has corrected a little close to 14% from its peak. I mean, we look at the actual overall market, which is the mid cap and the small cap index. We can see that the mid cap index has corrected a little close to 19 and a half, roughly 20% in the last, say, since September. And the small cap has corrected even more to a little close to 23%. We can also see from a technical perspective that the small cap index has entered into a stage 4 decline, which is a term coined by Stan Weinstein in a study where he explains what stage analysis is. And we can see directly that there is a good 23% decline in the small cap index. And when we look at the overall market, Nifty total market, it has given a correction of almost 17.5% as well over here. Now, if we look at what is the PE ratio of these indexes, firstly at the small cap index, the PE ratio, which was a little close to 35 at December at its peak, has dropped down to almost 26.7 right now, which is a little close to its 5 year average. The 5 year average is at 28.8, and that's a little lower than the 5 year average. The same way, if you look at Nifty as well, Nifty has also given a correction in its PE ratio from a peak of 24.4 to almost 20 now, which was at a 5 year average of 22.7. So now we're a little below the 5 year average. Looking at the Nifty mid cap index, we can also see that this is also corrected from a peak of 45.8 to 34.2 right now, where now the median is still a lot lower than the current PE ratio. And there is a high probability that the PE ratio will come back to its median PE before starting with the next bull run. Now, my point here is that the market goes in cycles. I've explained it to you how these cycles work, where rate cuts and consumption plays a crucial factor. There's a lot of other factors as well, but these are the two important factors which decide what is the next trajectory of the market. Now we can see that since the last 4 years, the market, since 2020, the market has just given a one-side move of almost a little close to 250% close on Nifty, while it has given on almost 469% return on the mid small cap index, which is the general overall market. Now, the market goes in cycles where it has cycles of its economical growth and economical slowdown. Since the last 1 year, we have been in an economical slowdown market. And since the last 1 year, because the slowdown had been taking place in quarter three of FY25, we saw the slowdown materializing where we could see actual numbers where the market was slowing down. And because of this reason, now we can be sure that the markets have entered its downturn cycle, which is very common for a market to have. Every market has its ups and downs. What is important over here is that from a correctionary point of view, I personally feel that there is not much room for a price correction to happen where the market falls a lot more, say to 30%, 35% on an overall mid or small cap index level. But now, for the next few months, at least for the next 6 to 8 months, the market is going to be in a sideways consolidation phase where, again, after the rate cuts which are currently happening and the consumption increase, this will all lead to increase in the top line and the bottom line of companies. After which the company will again enter into the next stage of its bull run. But definitely for the next 6 to 8 months, I personally feel that we are not going to go down a lot more from here, but we are not just directly going to jump back to our all-time highs or make new all-time highs. So yes, this has been my commentary on the markets, what is happening currently in the market, and what to expect going forward. One thing that I will leave you all with is right now, I personally feel it is the best, absolute best time to focus on stocks which are direct beneficiaries to the consumption increase. These companies will be FMCG, consumer durables, electronic appliances, EMSs. So these are the companies that are going to be the most favored by the increase in the tax slab and the decrease in the RBI repo rates, which will lead to cheaper borrowing, which will, of course, lead to more top line for the company going forward. And now, if you focus right on good companies at decent valuations and start accumulating them slowly in tranches, you can definitely see, at least on the mid cap and small cap companies, you can definitely see a 2x or 3x in the next 2, 3 years. That's for sure that you can see a 2, 3x in the next few years. But that will 100% depend on what your stock picking is. If you pick right stocks in the right sectors, and most importantly, at right valuations. It doesn't make sense to buy stocks when they are falling right now, but once they start consolidating a little, that's when you can start buying into tranches a little by little. And you can deploy all of your money once you see a clear confirmation from the markets that now the markets are turning back. Instead of making new lower lows, which the market has been doing since December, where they have been making lower lows like this, we want to see something like this going forward in the markets. This is what we are targeting. This is the most important thing on an index level. Definitely, stocks are going to start moving up a long time before the index takes a turn. But that's what we need to focus on right now. A lot of technical analysis paired with proper fundamental research is going to help you a lot going far forward to make new multi-baggers. So this has been it from my side. Thanks for watching this video. And if you do like it, then definitely let me know in the comments. And I'll be back with another video soon enough with something more interesting.